We are currently witnessing the biggest collapse in the money supply since the Great Depression back in the 1930s. Now this is truly uncharted territory we are now entering, as the money supply has never contracted in modern times, and usually a simple slowdown in the growth of the money supply signals that a recession is coming. Now the true money supply started to decelerate in April 2021 before turning negative in November 2022 for the first time in 28 years. Since then, the unprecedented decline in money supply has continued for the last 12 months in a row, and as of October 2023 sits at minus 10.49%. Now this chart uses two metrics, the M2 money supply as well as the Rothbard-Salerno money supply measure that is dubbed the true money supply by many, which is the metric developed by economists that is designed to provide a better measure of money supply fluctuations compared to the M2. With negative growth in the money supply now falling near or below minus 10% for 8 months in a row, this money supply contraction is the largest that we have seen since the Great Depression. And prior to this year, at no other point for the last 60 years has the money supply fallen by more than 6% year over year in any given month. Money supply growth can often be a helpful measure of economic activity, while also being an indicator of coming recessions. During periods of economic boom, money supply tends to grow quickly as commercial banks are handing out more loans. The fact that we are now not just seeing money supply decelerate, but that we are actually now in significant contraction is really shocking because it has almost never happened in history, especially not in modern times. And for context of how much money this actually is, the money supply has now fallen by $2.8 trillion, which is a 13.1% fall from the peak in April 2022. And this is proportionally larger than the Great Depression, where Rothbard estimates that the money supply declined by 12% from the peak of $73 billion in mid-1929 to $64 billion at the end of 1932. The money supply is of course linked to interest rates, and an inflationary boom reverses once new injections of money dry up, which is what we are experiencing right now. The Federal Reserve slowed down on their money creation after more than 10 years of quantitative easing and low interest rates, an environment in which money was really easy to obtain. Without this easy money, where interest rates were at close to zero, banks are less keen on writing loans, which means that unprofitable companies are no longer able to keep relying on new loans coming in at low interest rates to delay going bankrupt. When you combine less lending, high interest rates and a contracted money supply, it is a dangerous cocktail of conditions, and we are beginning to see real signs of this starting to wreak havoc across many areas of the economy. The labour market is one area that looks to have now truly cracked, with there now being a number of red flags pointing to a wave of mass layoffs soon. Of course, when corporate loans are harder to obtain and more expensive to finance, any companies that are struggling to make profit are really having a tough time right now, especially compared to a couple of years ago. This leads to companies abandoning projects that require financing, trimming the fat from their operations by laying off their less efficient workers, and obviously in some cases going bankrupt. Now, job opening figures for the month of October just came in at 8.7 million, well below the expectations of 9.4 million. This marks a 6.6% decline from September, which equates to 617,000 less job openings and is the lowest total since March 2021. This now brings the ratio of job openings to available workers down to 1.3 to 1, despite this ratio being around 2 to 1 just a few months ago. And the interesting thing about this decline in job openings is the fact that it was widespread rather than being driven by a specific industry. However, education and health services was the sector that saw the biggest decline of minus 238,000. The labour market was extremely favourable to workers in 2021 and the back end of 2020, with many employees, especially those who are skilled, able to command what they wanted to be paid and receive generous pay rises. If their current employer did not pay them what they wanted, they could easily just quit and move to another company who would offer them the money that they wanted. We're seeing a reversal of this power dynamic though across the labour market ever since rates started getting hiked, and the power is now firmly shifting away from employees towards employers. We are now seeing a dramatic fall in the share of workers who are voluntarily quitting their jobs, which is perfectly explained by the trend that we are seeing in wage growth for job switchers, which after surging in 2021 and the start of 2022 is now falling drastically. Clearly, workers are finding that not only is there far more risk to quitting your job in today's market, but there is also far less potential reward to be gained. We are also seeing the average weekly hours of work declining too, suggesting that there is simply not as much work out there compared to a year or so ago, which impacts shift workers in particular. A default cycle also looks to be fully underway thanks to the current high interest rates that are set to stay higher for longer. Ever since the Fed started hiking rates, we are seeing a surge in the number of defaults on speculative grade loans and bonds. A surge in defaults typically happens during periods of recession, and this can be seen back during the dot-com bubble, the global financial crisis, as well as during the start of the pandemic. And this surge we have seen so far is likely to just be the beginning of a larger wave of defaults when we take a look at the maturity wall that is coming soon. Here we can see that the amount of debt maturing will get higher and higher each year, peaking in 2026, where it will be more than double the figure in 2023. And this is also now starting to be reflected in the share of high yield bonds that are maturing in the next 3 years, which has also increased rapidly. These higher risk companies that took out these loans are facing the choice of completely paying off their loan or refinancing at a much higher interest rate. And many of these loans were taken out at interest rates of around 3 to 4%, but are now having to be refinanced at on average around 10%, which is obviously a big jump up in financing costs. Neither of these options are possible for a significant portion of these companies who in many cases are either struggling to make profit or have never made profit. And these extra costs that will come from refinancing their loans is pushing many of these companies over the edge into bankruptcy, and we are predictably starting to see a rise in bankruptcies take place now, approaching the peak that we saw in 2020 amid the craziness of the pandemic. Of course, while interest rates are set to remain high for a while, and with the vast amount of debt coming due for refinancing soon, we are likely to see this trend upwards in bankruptcies only continue to go higher. The bond market is also showing major signs of a recession as the yield curve is inverted and has been for over a year now, a signal that a recession is coming soon. Economists commonly use an inverted yield curve to predict that a recession is on the horizon for the simple reason that this has never failed in the past. Throughout history, every single time that the yield curve has become inverted, we have seen a recession follow not long after, and this includes major recessions like the global financial crisis. An inverted yield curve is when long-term interest rates drop below short-term rates, indicating that investors are moving money away from short-term bonds and into long-term ones. Under normal conditions where everything is fine in the economy, you would ordinarily get a higher interest rate on longer-term bonds, which take on more risk compared to a short-term bond. When this flips the other way round, causing a yield curve inversion, where you are getting a higher interest rate on short-term bonds compared to long-term bonds, it suggests that the investors in the bond market are becoming more pessimistic about the economy in the short term. The two bond durations that are normally used to determine the yield curve are the difference between the 10-year Treasury yield and the 2-year Treasury yield, but I have also seen others use the 10-year and the 3-month difference. Now, leading indicators for the US economy are also starting to paint a grim picture of where things are heading in the future, and there are now some scary parallels to previous times of recession and crisis. Now, this leading economic index is defined by the Conference Board as providing an early indication of significant turning points in the business cycle and where the economy is heading in the short term. This index has 10 components that are all indicators to predict future economic performance, and this includes weekly hours worked, jobless claims, a variety of manufacturing order numbers, building permits, money supply, interest rate spreads, stock prices, and also consumer expectations. And looking at this index that is showing year-over-year percentage change, we can see that we have been in negative territory for some time now and have now reached minus 7.6%. This is a big problem because historically any time that we've gone below minus 5% has coincided with a period of recession. This minus 5% threshold was reached during the global financial crisis, the dot-com bubble, the 1990s recession and the 1980s recession as well, which means that right now this index is signalling that we are now either in a recession already or one is coming soon. Now, the debt crisis that the US government is facing is also another major concern for the future of the economy, and Ray Dalio has recently issued a big warning on what the consequences of this could be. I cover this in more detail in my previous video, which you can check out by clicking on screen right now. Aside from that, please leave a like on the video and subscribe if you enjoyed it, that does help out the channel a lot, and apart from that, thanks a lot for watching.